Today's lesson will be Chapter 15, Problem 4B. You should be able to see the Excel spreadsheet that I prepared for this problem. This again is for Chapter 15, Problem 4B. We're going to be looking at investment reporting. We're going to be the Teasdale Incorporated manufacturing company, which sells commercial and residential security equipment. The following selected investment transactions occurred during year 2. And so they don't ask you to actually prepare the journal entries, but I wanted to do this as a review for this chapter and because it will help you when you get ready to prepare your balance sheet as the last requirement for this particular problem. So I'm going to look at each one of these transactions with you. We're going to start with the March 18th transaction, and we're purchasing 800 shares of Richter Incorporated stock at $40, and that includes the broker's commission. And they're telling you that the Richter is classified as an available for sale security. So it's always important that you look at the type of security that you have here. What we mean by available for sale securities is that it is a security that might be short-term, it might be long-term, depending on how management wants to hold on to those securities. In this case, we are talking about stocks, which are securities, but available for sale securities could also be bonds. But in this particular journal entry, we're buying stocks in a Richter company, which are available for sale types of stocks. We're going to record our available for sale types of stocks at the cost. In this case, there were 800 shares that we purchased at $40 as the cost per share. So if you multiply 800 times 40, it will give you 32,000. We are debiting this to the asset account called Investment in Richter Incorporated. This is available for sale stock that we're talking about. And because they didn't tell us management's intent, we don't really know if this is a current asset or a investment type of asset, but it definitely is an asset. And so our assets are always increased on the debit side. And that's what we're doing here when we're buying these shares of stock. We're going to credit our cash account for $32,000. On July the 12th, we have dividends of $12,000 that are received on the right company's investment. Now, something that this problem failed to tell you was that the right company investment was an investment where we own more than 20%, but less than 50% of the shares of stock. In other words, this investment in right company is accounted for using the equity method of accounting. And what that means is we have bought enough of right company stock to share in the dividends for their stock, but we also are going to be able to share in the net income of the stock. Now, when you record a dividend under the equity method, you will credit the investment in right company stock because dividends really reduce the amount of the net income for the right company. That's why we're crediting our asset account for the $12,000. So because these are counted for at the equity method, because right company, we purchased more than 20% of the shares of stock, but less than 50% of the shares of stock, somewhere in between 20 and 30% we purchased. we're going to record these using the equity method. So my cash account, of course, is going to increase because it's an asset, and to increase cash, you would debit. My investment in Right Company is going to be credited because dividends will reduce the asset account under the equity method. On October the 1st, we also purchased 24,000 of Toon Company's 4% 10-year bonds. We bought those bonds at what we call 100%. This 100 here is actually a percentage, and what it means is we bought the bonds at face value. If we had bought the bonds above 100%, we would have had a premium that we would have had to record. If they were bought below 100%, we would have had to record a discount. But since they're purchased exactly at 100%, that means that these bonds are purchased at their face value of $24,000, and the market rate of interest would be equal to the contract rate of interest on that particular date that they bought the bonds. And so we're buying bonds at the face value. We're buying bonds at 100% of $24,000. We would debit our asset account investment in Toon Company available for sale bonds at $24,000. Our asset is going up. That's why we're debiting it here. We are crediting our asset cash because it's being reduced by $24,000 because we spent some money to make an investment in Toon Company bonds. At December 31st, the Right Company reported a total net income of $80,000 for year 2. Remember, these are year 2 transactions that we're working on. Teasdale recorded the equity earnings for its share of Right Company's net income. This is how I knew that we were using the equity method, but I feel like they should have told you up here in order for you to get this journal entry correct on July 12th, this journal entry right here correct. You had to know that we were using the equity method. In dividends, we're reducing the investment account. We're not recording it as dividend revenue under the equity method. Also, because we're using the equity method, what's relating to the journal entry on December 31st is that we get to share in the net income of the Right Company because we own between 20 and 50% of the shares of stock. Now, they just happen to tell us that the investment in Right Company stock is using the equity method, and it represents 30% of the outstanding shares of Right Company stock. So we actually own 30% of the shares of stock in Right Company, and therefore we are going to use the equity method when we account for this investment. We will debit the investment in Right Company account because we get to share in 30% of the $80,000 net income. That makes our investment stronger or increase in the Right Company account. So 80,000 times 30% ownership gives you 24,000. Our investment account would increase, and the income of Right Company's account will also increase. This is a new account that was introduced in this chapter, which will end up on your income statement in other income. So when we own above 20% of a company, but less than 50% of the company, we always use the equity method to account for those types of stocks. So we get to share in the net income of the company if we're using the equity method. And this is how they're sharing in the net income in that journal entry. Also on December 31st, we have accrued interest for 3 months on the Toon Company bonds that were purchased on October the 1st. So when we're accruing interest, because we're buying bonds as an investment, or we bought the bonds as an investment on October the 1st, we are going to be earning interest off of these investments. We have not received our first interest payment. We're only showing that we're going to accrue interest at December 31st, so we can make an adjusting entry for the accrual, which will bring our accounts up to date when we prepare our financial statements. So the accrued revenue will always be a debit to some type of receivable. In this case, because it was accrued interest that we're talking about, is going to be interest receivable. This interest receivable is an asset account and would go on the balance sheet. The amount of the asset is debited for the amount of revenue that we've earned to this point. The amount of revenue that we've earned to this point is $240. We get that by taking the $24,000 face value of the bonds, multiplying it by half of 4%, which is 2%, and then we divide that by 2, because there was October when we bought the investment, there was November, and there was December. There were 3 months out of the first semi-annual payment that we are accruing. So technically there's 6 months. And you could have taken 24,000 times 2%, the interest rate. That would give you a half a year's interest or 6 months interest. You could have divided that 6 months interest into the amount that you get here, and that would give you 1 month's interest. But since half of the 6 months is gone, I just chose to simply divide it by 2 here. You could have used 3/6 to multiply by the 24,000 times 2%. There's 2 ways to get this, but the 2% is half of 4%, because we are paid interest semi-annually. They pay interest on October 1st and April 1st. Notice it's December 31st. So that's why we're accruing 3 months of interest, or we're accruing half of 6 months of interest, which would be 3 months. So 24,000 times half of the annual interest rate divided by 2 will give you $240, and this is interest that we have accrued. I've also shown you out to the side here in this calculation how you could have drawn that out, or made the formula to something that might be more understandable for you. If you'll notice here, what we did is we took the 24,000, which was the face value of the bonds. We multiplied it by the annual interest rate, and then there were 3 months interest that had accrued. So you take 3 and divide it by 12 months in a year, and that will also give you $240. There's a couple of different ways you could get that interest amount. I don't care which way you get it, as long as you get the right answer, the correct answer. So you can do it any way that you choose. In the next part, they have given you some information about the investments. They're telling you that the investments are classified as available for sale investments, and the investments at cost and fair values on December 31st of year one are as follows. So notice these journal entries were all for year two, but we have to know what happened in year one to be able to keep up with the fair value at the end of year two. So they've given you this information in the problem. And so what we know from last year's balance sheet date at December 31st, year one, is that we owned Alvarez stocks. We own 960 shares of those stocks. They originally cost us $38. If you multiply 960 times 38, it will give you the total cost that they gave to you in this problem of $36,480. And at the end of year one, we would need to calculate the fair value of those investments. This amount right here was given to you. We don't know what the fair value per share was. This was just something that was left over from last year that we have to take in consideration for this year's financial statements. Last year, we had a fair value for our Alvarez company's stock at December 31st of year one of $39,936. They gave you this amount. The Hirsch company, we also earned 1,900 shares that had originally cost us $28.80. If you multiply 1,900 times 28.80, it'll give you the total cost of those shares. But at the balance sheet date, our available for sale securities have to be valued at their fair value. So the fair value of the Hirsch Incorporated stock at the end of year one on the balance sheet date was $60,040. The total fair value for our portfolio is $99,976. The total cost of both of these investments was $91,200. You can compare these, the total cost with the fair value at December 31st of year one. You can see that the fair value was more, so we had an unrealized gain that we are dealing with. In other words, if you want to make the computations, the total cost was $91,200. We got that from cell F44 right here. It's total cost of those investments. We're going to compare that to the fair value of those investments at the balance sheet date at year one. The difference between these is an unrealized gain. Notice I've got gain highlighted there. This account would actually be called unrealized gain, parentheses loss, just like I've got it here on available for sale investments. But you need to realize that this is a gain, because the gain would have to be credited in our journal entry. So at December 31st of year one, our unrealized gain or loss had to be credited because this was a gain, and gains increase our stockholders' equity when we are using available for sale securities, or when we have purchased available for sale securities. So this unrealized gain or loss is a gain. It's going to show up under stockholders' equity as a positive amount because it is a gain. We do not put the unrealized gain or loss on the income statement because we had purchased available for sale stocks. If we had purchased trading securities, then we would have put the unrealized gain on the income statement under other items. But that's not what happened here. We're purchasing, or we bought, available for sale stocks, which means that management could possibly sell them if they wanted to, or they could hold on to them if they wanted to. We really don't know what management's intent is in this problem, because they didn't tell us. But in the real world, your management would have some idea of what they were thinking, because you really need to know what management's thinking in order to get them classified properly on the balance sheet, because available for sale stocks can be held temporarily. They could be a current asset, or if available for sale stocks were going to be held on to for more than a year, they could be investments. So it's important to know management's intent, but they didn't tell us that in this particular problem. So that's the journal entry at the end of year one to show that there was an unrealized gain on these investments at the balance sheet date. They also, in this problem, gave you the fair market value information for December 31st of year two. Adjusted the available for sale portfolio to fair value using the fair value per share amounts. These are available for sale investments that we're talking about. This is the fair value of those investments. Notice the fair value at the end of year two is $41.50. So it has gone up from the last year. And so we are still going to end up with a gain on this particular type of investment. So this information right here, class, was given. This is just the fair value at the balance sheet date of all of these types of stocks and bonds. Also, what they wanted you to do is they wanted you to calculate the total cost of all the shares of stock that you own at year two, as well as the bonds that we own at year two. So we still own 960 shares of Alvarez stock. This $38 was the cost of that stock originally. If you multiply 38 times 960, it will give you the total cost. But then you have to calculate the fair value at year two. So what we would do is we would take 960 shares of stock that we own of Alvarez stock and multiply that by the fair value amount of per share, which is $41.50. That will give you the total fair value of the Alvarez stock at the end of year two. We had some Hirsch Company stock. We had 1,900 shares. 1,900 shares times $28.80 will give you the total cost. Then we're going to take 1,900 shares and we're going to multiply it by $26 per share, and that will give us the fair value of the Hirsch stock. The Reiter Company stock, we had 800 shares. It cost us originally $40. So if you multiply 800 times 40, it will give you $32. This is stock that we've actually bought as an investment. You might remember from the very first journal entry here, you can see the cost of that stock was $32,000. That's where we're getting this amount right here. The fair value at the end of the year has gone to $48 per share. So we're going to take 800 shares that we own and multiply that 800 shares times the $48 fair market value per share to get the total fair value. We also bought in this year Toon Company bonds. We purchased those bonds at a face value. And that actually happened on the October 1st journal entry here. Do you see where we bought the bonds at $24,000. That's the face value. That's what the bonds cost us. Now, it tells you that the fair market value of these bonds have changed. And what that means is the contract rate of interest is no longer the same as the market rate of interest. And what they're telling you here is that the fair market value is now stated as a percentage, which is 1.01% or 101% per $100 of the face amount. So in other words, we could have found the fair value of the bonds by taking the face value of the bonds, which was $24,000, and multiplying it by the percentage that the bonds had increased in fair value at the balance sheet date. This 101 is a percentage. So I multiplied that by 1.01 times 24,000, and that's how I get the face value of the bonds. So then you're going to add up your entire portfolio to get the total cost of the portfolio, and then we're going to look at the fair value of the portfolio. Notice it's higher than the cost, so again we have a gain. And I've stated that in these computations for year 2. We start with the cost of our portfolio for year 2. Our group of stocks and bonds all added together was $147,200. The market value of this group of stocks and bonds is $151,880 at the balance sheet date. It's increased over the cost, so there is an unrealized gain on available for sale investments. This is an unrealized gain because it hasn't happened yet. And these unrealized gains on available for sale investments will end up in your stockholders' equity. But the gain has to be shown in a journal entry. To record the gain, we are going to credit the unrealized gain or loss on the sale of the investments. We have to have an account that offsets that credit, and that account is the valuation allowance, which is available for sale investments. This account you're going to find on the balance sheet. This is the account which will adjust the investment from the cost to the fair market value. So let's look at what would happen for an income statement for year 2 of Teasdale Company. They don't ask you to prepare an income statement, but I think it's important that you know where your accounts are going to end up. Notice on the income statement in the other revenues, gains, expenses, and losses category, we're going to list the income of the right company. This account right here is an income statement account. The amount is $24,000, and we get that amount and I'm sorry, that's not technically true. This should not be just 24,000. It should also be the total amount of this company's stock would go here, and that total amount is going to be $81,200. And so we need some explanation about that, I know, but I made a mistake here, so I'm going to fix this. This income of the right, no, I apologize, I'm wrong. This says income of the right company. So the income amount was correct. So sorry, class, I lost my train of thought there. We shared in 80,000 of the income, the net income of the right company. We own 30% of the stock, so 30% times 80,000 is 24,000, and that 24,000 income of Wright Company stock would show up on the income statement as I have it prepared here at 24,000. Also on the income statement, we would record the interest revenue. All of your revenue accounts will show up on the income statement. This is another type of revenue. That's why I've got it under the category of other revenues, gains, expenses, and losses. This is our revenue amount. The total of the other revenues, gains, and losses for this company is $24,240. That was your income of the Wright Company and the interest revenue combined together. That's the total amount that would eventually add to the income from operations to give you the net income for this particular problem. Now, in the next part of this, they gave you a balance sheet, and they gave you all the account titles, and they gave you some of the information for the balance sheet at year one. All of this information right here in year one was given to you. This is what the balance sheet looked like at the end of year one. What we're going to do is we're going to prepare the balance sheet at the end of year two, and you'll notice that we've got some blocks here with amounts in them. These were actually blank boxes, or missing values were in these boxes here. And so I'm going to show you how we come up with those missing amounts. For the missing box for the available for sale investments at year two, this box right here, this is how we calculate the amount to go in that box. We've got to determine what the available for sale investments cost us at December 31st. You'll remember that we had some available for sale stocks that we had purchased last year, such as Alvarez and Hirsch. But this year we purchased Reicher and Toon Company stocks. The total amount of our cost is $147,200. This amount will go on the balance sheet in the block that was blank. So that $147,000 comes from the total cost of our investments at the end of year two. Now on the next line, we're going to look at our valuation allowance for the available for sale investments. Last year, we calculated an amount of $8,776 in the journal entry that we prepared for year one. And that was this journal entry right here. This 8,776 is where we're getting the amount for the balance sheet for year one. That's the amount that they've got here. What you had to do is you had to find the missing amount that was for the balance sheet date of year two for the valuation allowance. So that comes from the journal entry from December 31st of year two, where we adjusted our fair value, and that amount was $4,680. And so that's what goes in right here. I've also put out here to the side so you would know how we're getting these missing blanks on your balance sheet, on your problem. This is how we calculated the amount. This is showing you where I got the amount. It was from cell address D76, which is right here. And these were the computations for that. So we're just filling in the missing amounts. On the next block here, this is going to be the available for sale investments at the fair value. So we take our cost and we add to it the valuation allowance, and that brings us up to the total fair value. And you can see that that was also calculated as 147,200 plus the 4,680. It's really these two added together here, class. We'll give you that. In year one, we didn't have any interest receivable, so it wouldn't be anything on the balance sheet for that. But in year two, we have some interest receivable, and that came from the journal entry where we accrued the interest receivable, which is at cell address D36. So right here is your interest receivable. That's where they're getting that $240 amount. That's what goes right there. On the next part, we're looking at the investment in the right company. Now, last year, the investment cost us $69,200. You're going to have to do some figuring here. What you have to remember is that last year's beginning balance, which is this $69,200, you would have to subtract out where you credited this account, where you shared in the dividends for this account. Do you see where you credited this account for $12,000? When you credit the investment account, it's going to reduce it. So that's why we subtracted E18 from the balance sheet balance of the investment account in year one minus the dividends. Then we're going to add back in the share of our net income that caused the investment account to go up. Our investment account went up here at $24,000. So the beginning balance less the dividends received plus the net income that we shared in this problem is how they're getting or arriving at this $81,200. And that's the block that they want you to fill in for December 31st, year two, balance sheet amount. This amount is how we calculated that $81,200. The office equipment amount here was just given to you. You didn't have to figure anything in this one. Our next block that we have to figure out is our total assets. I want you to be careful when you're adding up your total assets, because it's real easy to go up here and just add everything together. But what you have to realize is the cash plus the accounts receivable plus the fair value of our available for sale investments plus the interest receivable plus the value of our investment in right company stock plus the office equipment, that's how they're getting this amount. Again, I've shown you that in this formula here as to how we're coming up with it. The D96 was given to you. That's the cash amount, $160,000. The D97 was given to you at $115,000. The available for sale investments was $147,200. Then we've got to add to that the valuation allowance because we had an unrealized gain that added to the fair market of those investments. You do not put this amount in here because we've already got it recorded up here. Put it in separately. And then we move to the 240, which was our interest receivable. And then we'll put in the 81,200, which was our investment in right company stock. Then we'll add to that 96,000 to get a grand total of 604,320. The accounts payable amount was given. Didn't have to do anything to accounts payable. You didn't have to do anything to common stock. They gave you that. You didn't have to do anything to the excess of issue price over par. The next thing that you have to know about retained earnings is that the beginning balance of retained earnings is $127,400. To this, we must add our net income for the period. The only way you know what the net income is they've given you this information in your problem, where it tells you that you're closing the Teasdale Incorporated net income for $51,240. That's your net income. Your beginning revenue amount, your beginning retained earnings amount, which was $127,400, plus your net income is how we come up with the total ending retained earnings balance. So you're going to have to figure that up, and you need to know that beginning retained earnings plus net income minus any dividends that were paid out by the Tisdale Company will give you the ending balance. The Tisdale Company or Teasdale Company did not pay out any dividends. So we just simply take the retained earnings, we add the net income to that, and that will give you the year-end balance of retained earnings. Your unrealized loss or gain or loss, in this case it was a gain, was $4,680, and that came from the adjusting entry that we prepared right here. This is your unrealized gain or loss. This was the adjusting entry amount. This is what is going to be recorded in your stockholders' equity section as the unrealized gain for this year. Then your total liabilities and your stockholders' equity would be combined together. Accounts payable, $91,000, plus common stock of $80,000, plus paid in capital in excess of par value or excess of issue price over par, $250,000, plus your retained earnings balance, plus your unrealized gain gives you the total amount of $604,320. And that's all you were required to do for this balance sheet. There really should have been a journal entry that you would have recorded to close your net income. But that journal entry, we don't have all the information for that. So that's why I did not prepare that journal entry for you. The journal entry would have been something like this. There would have been a debit to the total amount of the revenue to reduce the revenue account to close it out. They didn't tell us what our total revenue was for this company, so we couldn't really make that journal entry. You would have reduced your expenses by crediting them when you're closing them out. They didn't tell us the total amount of the expenses. But what we do know is that the net income amount will add to the retained earnings. So we would debit the retained earnings for the amount of the net income, or excuse me, we credit the retained earnings for the amount of the net income, because net income adds to retained earnings. And that's this balance here. So I'm going to stop here. This is your last video for this particular chapter, and we'll continue on with our videos for chapter 16 at another time. So we'll stop sharing this, and I'm going to stop the recording. See you next time.